August was a wild month. The S&P 500 was down 4.2%. The unemployment rate ticked up from 3.5% to 3.7%. And the markets had their sharpest one-day drop in months. One of the best things, though, about being a cash flow investor is that drops in the market, even steep drops that scare most investors, do not bother me. I actually had one of my best cash flow periods in months, and I want to share with you just how I did it and how I slaughtered, no joking here, slaughtered all of the major indexes in both capital appreciation and cash flow. Make sure to stick around to the end of the video because I've got another Average Joe live Q&A with an audio message left for me with a question where I answer it. Alright, here's my August 2022 income report, where we not only show my portfolio's results since January of 2021, as well as year to date, as well as just for the month of August, but we also compare my results based on capital appreciation and based on cash flow against 6 different portfolio options. We'll also take a look at a monthly income breakdown month over month. We'll take a look at a quarterly income breakdown and a portfolio balance snapshot all the way back from January 2021 to August 2022. We're comparing my portfolio results for cash flow and capital appreciation against the NASDAQ 100, QQQ, the S&P 500, SPY, the Schwab SCHD Dividend ETF. We're talking about Devo from Amplify, which is a great dividend ETF, the Global X NASDAQ 100 Covered Call ETF, QYLD, and the JP Morgan Equity ETF, JEPI. This spreadsheet is an apples-to-apples comparison of my portfolio against these other different portfolios. To be completely transparent, the NASDAQ 100 QQQ and the S&P 500 SPY are not really cash flow type of investments, whereas Schwab's SCHD, Devo, QYLD, and JEPI are in fact primarily cash flow investments. My portfolio compared to these two indexes really serves to show the staying power in my capital appreciation or lack of capital losses in the portfolio, whereas my portfolio against these income investments show just how much more cash flow I generate than what you can get out in the open market. All right, let's focus in here on the month of August 2022. My portfolio started out with a balance of $160,449.55, and the ending value on August 31st was $164,616.88. When you factor just the starting balance and the ending balance, including deposits, the portfolio was up 2.60%. However, when you get rid of the deposits I made into the account, the overall portfolio was down 1.77%. Total cash flow for my portfolio for the period of August 2022 was $2,339.04. If you compare my results against all of the other options, you'll notice that the only portfolio that beat me based on overall portfolio value was the Amplify Devo dividend ETF here, 3.13% overall, and it lost money as well, but just slightly less than me. It was only down 1.52%. And that portfolio did have cash flow as well, $646.23 in dividend income for the month. The only two portfolios that were down for the month, even including the deposits that I made, were the NASDAQ QQQ down 0.13% and QYLD down 1.37%. I had nearly double the cash flow of any of the other investments. Both QYLD and JEPI had around $1,300 in cash flow for the month, and I was at up near $2,400 for the month. QQQ, SPY, and SCHD did not pay any dividends for the month of August. So that's just a snapshot of 1 month. How does my portfolio compare year to date? Back from December 31st, 2021 through August 31st, 2022, the only portfolio that was up on the month year to date is my portfolio, up $2,516.44, or a capital percentage increase of 1.81% with year-to-date cash flow of $14,439. You compare that against the QQQ down 22%, both the S&P 500 and the NASDAQ 100 QYLD both down 13%, SCHD is down 6.41%, JEPI is down 4.07%, and then Devo is down 3.62%. And when we look at the year-to-date cash flow, my portfolio just blows these other investments out of the water. The nearest investment is JEPI at $9,600. For full awareness here, I did deposit $7,000 in the month into the portfolio, but again, I made this an apples-to-apples comparison, and I included these same deposits into these other investments just to see how the results changed. So here's the overall results back from January 2021 through present day. All of the portfolio started with $52,173 on January 1st, 2021. And overall, best portfolio based on overall percentage of gain or loss was my portfolio at 215% up in that year and 8 months. SCHD is up just under 200%. Same with JEPI at 194.97%. And when you factor out the deposits, we have some losses here. My portfolio is up 34.53%. Then we've got SCHD at 26%. JEPI at 21% up during that time frame. QQQ, DEVO, and the QYLD ETF are all down for this period. You will notice that during this time frame that my portfolio came in second place when it came to cash flow. QYLD had $21,644.98 versus my $19,121. However, for the majority of this time frame, I was not selling any options on my portfolio. That's a recent development, and that definitely speaks to why my cash flow results are not number one. Here's the monthly income breakdown going all the way back to January 2021. My portfolio is in black and is routinely one of the top portfolios when it comes to monthly income. Now, this overall portfolio balance back from January 2021 through August 31st, 2022 is not a perfect representation because I do not keep daily running results for my overall portfolio balance through this time frame. It's just a month by month, end of month snapshot, whereas I have access to the daily results for all the other investments, which is why you see these very straight lines for the white, which is my portfolio. So you don't see quite as much of the volatility you see from the day-to-day changes for these investments, but you can clearly see that my portfolio has the top overall balance and has routinely been near the top of all of the portfolios. There's no secret sauce to my portfolio. I own, for the most part, quality dividend stocks that have a history of raising their dividend every single year. And then once I have these investments in my portfolio, on almost all of my investments, I sell call options or covered calls. These covered calls generate additional premium that I reinvest back into the portfolio to purchase new positions. As promised, here's a list of all of the transactions, all of the investments that I made with respect to the option premium that I collected. Also, for full awareness, the total of that $2,339 in overall income received by the portfolio, $881.85 was paid as regular dividends from investments in the portfolio, whereas an additional, let's go scroll all the way down here, $1,457.19 came exclusively from option premium. You'll notice I have multiple covered calls that I've sold for Best Buy during the month. This is one of my favorite holdings based on the amount of volatility as well as the historical dividend paying characteristics. We also have Colgate-Palmolive, Comcast Corporation, Devon Energy, and ExxonMobil, Gilead Sciences, Intel, the iShares Russell 2000 ETF, relatively big holding. We have the Schwab US Dividend Equity ETF here, SCHD, T. Rowe Price Group, Verizon Communications, and Walgreen Boots Alliance. The spreadsheet breaks down all of my entry days, what the option premium I received, the expiration of the option, what was my net premium, the collateral required, the buy to close cost if necessary. If you want to learn more about how I operate my portfolio, you'll have to check out the Patreon community and the resulting Discord server where you can interact with me as well as other investors who are like-minded and are also trying to generate as much cash flow as possible. If you want to check that out, there's a link down in the description below. All right, guys, it's time for another live Average Joe Investor Q&A. And this segment is sponsored by Moomoo. With Moomoo, you get an advanced stock trading platform with the ability to screen for stocks based on over 100 different indicators. Utilize their vast learning library to better understand how to sell options and much more. Plus, check out the link in the description and the comments below, and as a special offer for my audience, you can get up to 10 free stocks worth up to $2,000 per stock. Do not delay. Click on the link today. Okay, this question comes from Brooke. Let's take a listen.
Hey, Joe. My name is Brooke. I recently discovered your channel, and I appreciate all the good information you're putting out there. I have a question. I'm trying to balance a new dividend portfolio that is mainly comprised of the QYLD and the other covered call Global X ETFs with some ETFs that have upside potential, growth potential. So my question is regarding the difference between some of the ETFs that only write calls on a portion of their holdings, QQQX, for example, versus QYLG. The yields are surprisingly different between the two, even though they supposedly write calls on about half of their holdings. I would rather go with QQQX's 8 to 9% yield than QYLG's 5.5 to 6% yield. Wondering if you would agree with that if there's a hidden risk with the way QQQX is handling things, and maybe that 9% yield is not reliable. I don't know. Hopefully the question's clear, and I, again, appreciate all the information you're putting out there. Very helpful. So thanks, man. Take care.
All right, Brooke, that was a great question, and it's worth talking about. Really, the difference between the Nuveen QQQX ETF, which is actually a closed-end fund, and the NASDAQ 100 Covered Call and Growth ETF, QYLG, is really the structure. QYLG is absolutely going to have very rigid rules. They're always going to write at-the-money call options on exactly 50% of the portfolio every single month. They're not going to stray from that. Market conditions aren't going to change that. However, it speaks very clearly in the fund description for QQQX that they sell options on 35 to 75% of the value of the portfolio, with a 55% long-term target in an effort to enhance the fund's risk-adjusted returns. What that really says here is they have flexibility. There is discretion within the fund management to increase the amount of call options they sell or decrease it based on market conditions. This is how you can generate more yield and potentially have better price stability based on when you write those options and for how much. You are also going to find that QQQX does have a heftier expense ratio as a result. But to your point though, the distribution yield is different. QYLG is at 6.74% on a monthly basis, and for QQQX, we're at 8.72%. One potential downside is the fact that QQQX does pay quarterly distributions, as it mentions right here, whereas QYLG will pay out monthly. You'll also see that QQQX has 168 holdings, whereas QYLG, I believe, only has 100. At the end of the day, Brooke, you need to decide first off, is this type of investment a right fit based on your portfolio objectives, right? As opposed to just owning low-cost index funds or owning individual stocks. What are you most comfortable with, and what most aligns with your overall investment objectives? And then furthermore, as we decide between individual investments, QQQX versus QYLG, it ultimately comes down to what is most important to you. Do you like that quarterly distribution with the higher distribution rate, or do you prefer monthly? And how structured do you want that investment to be? Do you want them to have discretion to change it, or do you like the simplicity of how Global X and all of their covered call ETFs operate? I appreciate your question though, and hopefully the information I provided is going to help you. If you have a question out there and you want me to answer it, make sure to check on the link in the description below for the SpeakPipe leaving a live voicemail. Leave that voicemail, and I can almost guarantee you at this point your question will be featured on the show. Make sure to leave your 2 cents down in the comments below. I value you guys' feedback, and I always want to be making better content, so please let me know what you liked, what you didn't like, and everything in between.